So Hamish, Alex just put a pin in the banks. So let's take the pin out and dig a little deeper. I think a lot of us and a lot of advisors might think of banks as a classic defensive play. Is that the case? Like, how do you think about the Australian banks?
Having been in equities for 20 years and worked in banks for 30 odd, thinking of banks as defensive is a real mindset shift for me. Like, I think it's a very temporary thing. When things get bad, banks tend to wear it more than anything else. They tend to be the ultimate cyclical stock if you look at COVID and global financial crisis and things like this. Right now, they're having a moment in the sun, but I don't think of them as defensive. In fact, I think of them as quite expensive right now. If I could sort of talk about why I think they've done well, because they've been, everyone's talking about why is CBA the most expensive bank in the world.
Yeah, CBA is the ultimate growth stock.
Ironic, and look, I'm not in any. I'm not being critical of these companies. I think they're CBA is an extremely well run company, but I don't want to pay, the most expensive. It is a slightly less attractive company from return metrics as JP Morgan, and you pay double the price for it. It's sort of like mind blowing. And there's a couple of things that have kicked this off, but I think the big one is, frankly, some of the big super funds. They publish their data every 6 months. You know exactly what they hold. They have to disclose it, and it's in files. If you laid them out in this room, it'd be longer than the room. It's like 3 meters long. But you can tell exactly how many shares of CBA, for example, they've bought in a half, and you can weigh that up versus the total assets they have and the total equities. And are they allocating to equities? Are they allocating to CBA? And you can see in the December half, for example, for every $1 of inflows, that if they were going to put $1 into CBA from inflows, they bought 11. Like, for some reason, even though CBA is the most expensive stock in the market, to my mind and to many people's mind, for reasons beknownst to them and we can speculate, they decided to buy even more CBA, right? And there are reasons. They're trying to get into growth, equity. So some people made that decision. Some people have been underweight. It's just hurt them terribly. The interesting thing is, after doing this for CBA going up for 18 months, and them buying a whole bunch, their underweight's the same, right? And I sort of get in the concept of underweights and overweights, but if you have an underweight to a stock and it goes up, your underweight gets bigger. You've got to buy more stock to keep the underweight. So I think one of the big drivers for the big super funds is they've got risk limits and they keep hitting the risk limit, so they keep buying. So the stock cross is going up.
Oh, yeah.
Is it to infinity and beyond? Do we sort of like Buzz Lightyear up to $1 billion? I don't. It goes the other way as well, right?
Yeah.
Like the cycle goes the other way. But I think that you can see this in the data. It's a very clear pattern.
If the super funds are still underweight and all the active managers are avoiding or shorting, who's buying? Is it just passive?
Well, the super funds are buying to maintain their underweight. A lot of them. And look, what's interesting is who's selling, right? Like retail. The big four banks release their share registers, who owns them in 3 categories. It's like retail, institutional, domestic, institutional, foreign. For years, it was a truism, retail doesn't sell banks, until 18 months ago. Retail have sold about 10% of their holding of bank shares in the last 18 months, right? They've just looked at it and gone, CBA, 2.8% dividend yield, CBA term deposit, 5.5%.
Yeah.
I'm going over there with my money, just like I need income, I can take this. So it's been interesting. Retail are the ones leaving, and domestic institutions, which include super, is buying.
Are the ones buying. Yeah, right. Okay.
Wow.